The forex market is the largest global financial market. While no other financial market can compare to the size of the forex market, these other financial markets do impact the forex market. Oftentimes you can receive advanced warning of what is going to happen in the forex market by watching what is happening currently in other financial markets. For example, if you see the value of gold rising quickly, you can look for a corresponding rise in the value of the Aussie dollar. Once you know what to look for, you can take advantage of the same correlations that the large institutional investors are watching. As a forex trader, you can gain valuable information and knowledge by watching the commodity market and the bond and stock markets in various countries. Let's start by looking at the commodity market. The rise of global demand for commodities has tied the commodity market and the forex market closer together. Virtually every economy around the world has to import some of the commodities it consumes. To buy these commodities, importers must exchange their currency for the currency of the economy from which they are importing the goods. This transaction drives the demand for the exporter's currency higher, which increases the value of that currency. This transaction also drives the supply of the importer's currency higher, which decreases the value of that currency. Three of the major currencies, the Canadian dollar, the Australian dollar, and the New Zealand dollar, are closely related to commodity values because they are major commodity exporters. As the price of commodities rises, the value of these currencies typically rises as well. As the price of commodities falls, the value of these currencies typically falls along with it. Paying attention to what is happening in the commodity market during the next few years can lead you to greater profits in your forex trading. Let's look now at the bond market. Next to the forex market, the global bond market is the second largest financial market in the world. Governments, institutions, and individual investors all participate actively in the global bond market, and each one of these market participants is looking for the same thing, a profitable return on investment. Government bonds make up the largest percentage of the global bond market. Typically, government bonds with higher interest rates are more attractive to investors, as long as the economies covering the bonds are relatively stable. Investors who wish to buy government bonds must buy these bonds with the currency of the represented government. If international investors wish to buy U.S. government bonds, they must first exchange their currencies for U.S. dollars. This increased demand for U.S. dollars drives the value of the U.S. dollar higher. At the same time, the increased supply of international currencies on the market drives the value of these currencies lower. Knowing which governments offer higher interest rates on their government bonds and which bonds are gaining popularity among international investors will help you know which currencies to buy and which currencies to sell. Lastly, let's take a look at the stock market. Individual investors around the world seem to watch stock markets more closely than any other market. When stocks are performing well, money from around the globe flows in to buy the hot stocks. When stocks are performing poorly, money flows out as international investors sell their shares. Stocks are priced in the local currency. To invest in stocks in the United Kingdom, foreign investors must first convert their currencies into British pounds. This increased demand for British pounds drives the value of the pound higher. At the same time, the increased supply of international currencies on the market drives the value of these currencies lower. Forex investors closely watch how the stock market in major countries are performing. To become a successful forex trader, you will need to learn the relationships that exist among the world's financial markets and how these relationships may affect the currency pairs you are trading.